Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital, and I thank you so very much for taking the time to join us this afternoon. Today, we will provide a brief macro overview of the markets, and we would be pleased to address your questions at the tail end of the conversation. You can hit me up on the chat or email me at phastings@barometercapital.ca. Joining me, as always, is David Burrows, our Chief Investment Strategist and President at Barometer Capital. I turn the conversation over to David. And it looks like a very festive background, and we'd like to wish everyone out there a very happy Hanukkah who's celebrating. And Dave, it looks like you're ready for the holidays, gearing up for those 12 days of Christmas.
Thanksgiving is over, and we're into the holiday season, it looks like. So welcome everybody. We got a bunch of people on the call today. So Pam, they must be here to see you. They're not here to see me. Interesting week. We went into U.S. Thanksgiving, and things were in pretty good shape. And we had a couple of surprises this week. Of course, on the holiday itself, we found out that there may be a new strain of COVID, Omicron, which is certainly was a start to a lot of investors, made them rethink some things. And we've had some talk from Chair Powell this week, which also has caused people to reassess some things. And so I think probably the most important thing to take away is we always have to be flexible. You have to take what comes, and you make your decisions based on the facts that you have at the time. You have to be able to reassess your holdings. We're going to do that a little bit today. And always be willing to be flexible and make changes if that's what's required. So it's been an interesting last 3 trading days. And so we're going to talk a little bit about that. Just to start out, as we always do, take the lens back. We'll start with the basic premise that we've been in a structural bull market since 2013 when we broke out above the 2000 highs. Started in the US, but worked its way into markets around the world. So equities in general have been a generally positive backdrop with some notable interruptions. We think that we've been going through a generational bottoming in yields that's been going on now for the last short few years. That means that often what may work in rising rates could be quite different than what works in falling rates. So we have to keep that in mind. We always want to have sort of the structural backdrop in mind when we make our investments. And we also have had a view that we've been going through a reversal in a very long bear market in commodities. And we've talked about the fact that the 10-year rolling returns have finally turned positive after being almost minus 10% a year for the previous 10 years. And so that presents some opportunities, but there's messages that come away from this. And our basic premise has been now for 18 months that we are into the beginning of a reflationary environment, which at times can be inflationary, and that we have to be positioned accordingly because not everybody will come to that conclusion at the same time, as we found out today. So kind of a sloppy day out there in the world of markets, if you take it in a vacuum. There wasn't much that was green on the screen. Apple's a notable exception. So we'll talk a little bit about what causes some of that repositioning. But we'll start just from the top with the S&P 500. S&P corrected going through September, October, really started the end of August. We came out of that consolidation sort of on cue in mid-October, and market has been quite strong. The last 4 or 5 days have been tougher, pulling back sort of toward the 50-day moving average. Now, we've often talked about the fact that the S&P can be very misleading. It really does not represent what's happening under the surface. It represents what's happening in the very largest of the companies, with the top 5 stocks making up almost 24% of the index. So if they're performing well and underneath the surface, things aren't, you don't so much see it in the market. In fact, the average S&P company as of this morning has pulled back just shy of 15% off the highs. So it has been a notable correction in certain areas. Not all sectors are behaving the same. This is the equally weighted S&P 500. The equal weight S&P is down 5.3% off the highs. And really that's over about the last 10 days. Again, just really pulling back into the 150-day moving average. And if that's all it is, then that's not such a big deal. It's something that happens quite frequently. And we are headed into a pretty strong seasonal period. So there's the Russell 2000, Russell 2000's 2000 mid and small cap stocks. We are headed into a seasonally strong period. It certainly started that way, but in the last 2 weeks, the Russell 2000 has pulled back about 11%. So we'll try and deconstruct that a little bit. So we've been through sort of a bumpy pre-Thanksgiving period. It tends to be markets firm up following Thanksgiving. We've had some news that has had an impact. It's created some uncertainty and certainly things to think about. When we had the news of the Omicron variant, it probably has raised fears in investor minds that the recovery may be put off or delayed. Obviously, there's a health issue as to how quickly it may spread and how virile it may be. And we don't know. We know absolutely about the least amount of information that we will have over the next short few weeks. And slowly information will come out and give investors a chance to make their decisions. We choose to look at what the market is telling us investors are thinking. We don't purport to think that we know better, but we are pretty good at recognizing change in the market and what that may mean for the bigger picture. But we have to keep in mind that the market is looking forward 9 to 12 months as to what it thinks will be happening at that point. And certainly we are going to have more information, not less, as we go forward. The second shoe to drop was Fed Chair Powell today saying two things. First of all, that it may make sense for the tapering of bond purchases to be accelerated and be finished earlier. Now, on the surface, that's a good thing because it means that we may not need to raise rates as quickly in 2022. He certainly left the door open, given the fact that there's a lot we don't know about the new variant of COVID. So he will have cover if he wants to change his mind. But he did say that they would take the word transient out of the discussion of inflation, that perhaps it may be stickier. Now, for those of you who have been on this call, it's not a surprise. We do have a view we're in a reflationary environment. We do have a view that there is some real inflation. And we do have a view that we have to be invested to deal with that scenario. We can't assume we are still in a disinflationary world where low rates will last forever. So that being said, the seasonal tailwinds are behind us over the next number of months, with lots of mechanical flows that will find their way into the market, especially starting in January, as investors both in the US and in Canada start to put retirement savings money away and institutions start to position for the upcoming year. So S&P off a little over the course of the week and volatility higher. Now, a couple of things I want to note. We made a low on Friday in a very sharp sell-off that was probably fueled by the fact that so many people were not in their chairs in front of their screens. And not just in the US, but at large US investment banks and asset management companies around the world as their folks were off for Thanksgiving. It was going to be interesting to see what happened on Monday. Of course, we got a little bounce. And today with Fed Chair Powell's news, market took another step down. So we made a lower low today than we made on Friday. Yet importantly, the spike in volatility that we saw on Friday was not exceeded today. And in fact, volatility finished significantly below the highs of Friday. So one of the things we like to watch is what happens to volatility on successively lower lows, because if it continues to make new highs, it points to the fact that we may be headed for even more volatility. So if there is a ray of sunlight out of today, a difficult day, it's that volatility definitely did not fit the regular pattern, which is to make a higher high on a lower low in the market. I point out that when we look at the length of structural bull markets, they go on for a long time. Bull market we are in now is roughly half as long as the one we lived in through the 1980s and 90s. The percentage returns, which in the 1980s and 90s were over 1,000%, today from the initial breakout point is a couple of 100%. So we shouldn't be afraid of a market that has been making new highs. what makes new highs can continue to make new highs. And it generally happens because there's some kind of structural tailwind taking place for certain industries. Last week, we highlighted that our short-term indicators had turned more cautious and that breadth across the market was somewhat weaker. The percent of stocks trading above their 50-day moving average had reversed lower. The percent of stocks trading with positive weekly price momentum had moved lower. The percent of stocks making new highs versus new lows had moved markedly lower. And the percent of stocks trading above the 150-day moving average had moved lower, but the broad-based breadth indicator remained strong. Well, this week, we continued in that same direction. Short-term indicators continuing to weaken, and the long-term key indicators turning lower as well. Percent of stocks in the NYSE in uptrends, just a shade above 50%, down about 8% over the course of the week. So certainly that has our attention. And what does that mean? When breadth is contracting, we don't put on new positions. If we get stopped out of existing positions, they hit our stop losses, the money goes to the sidelines. And then we look for signs of strength. We don't put money to work in a weakening market. We look for groups within the market that are outperforming the rest of the market. And in fact, some cases going counter to the market before we start putting money back to work. So we'll keep you updated on these, but at this point, we are more defensive in our positioning. So let's talk a little bit about this week, right? We had two big pieces of news. Both of them created uncertainty. And what do investors hate the most? They hate uncertainty. So over the next days and weeks, investors are going to sort through the data and come to their own views as to what's going to happen going forward. But remember, we're not invested for the next 3 weeks. We're invested for next year. And there are some pretty clear signs coming out of markets. So let's talk about the leadership themes. One of our key themes has been that we believed that we are in the early stages of a reflating market. And certainly the conversation around the concept of inflation has been gathering some steam. In the last number of weeks, we have been seeing a steady increase in commentary from companies talking about the impact of inflation. Now, in some companies, inflation is beneficial. In some companies that have pricing power, their ability to raise price and stay ahead of inflation, in fact, take price, gives them an opportunity to increase their margins. And in some cases, companies that don't have that ability get hurt. So we have to really understand the sectors that we're invested in and the companies within those sectors and their ability to do that. So let's start with one of our big broad-based themes. We think that we've been going through a bottoming process in long-term yields. Back at the beginning of the pandemic, the 10-year bond yield got as low as 40 basis points and has been working its way higher. It corrected through the course of the summer, but now trading above long-term moving averages and the 50-week moving average solidly underneath where we are today. So we are today, I would say, in a longer-term uptrend in the 10-year yields. When we take a look at other issues, this is the 5-year bond. This is the yield in the 5-year bonds last August, last December, this August, this October, this November, making a series of higher highs and higher lows. I would say the 5-year yield looks as though it's working its way higher. Let's take a look at the 2-year yield. Same picture. It has been moving sharply higher. It certainly pulled back over the last week with discussion of the new strain of the virus, but we continue to make higher highs and higher lows. So yields in general look to be continuing to say to us, there's an issue. The price of a 2-year bond in Canada trading right near the lows. So when we think about what we're doing in our portfolios, we have to think about alternatives. One of the big alternatives during falling interest rates over the last many years was bonds. We got our coupon and you got some capital appreciation. What we know now is we're getting exceedingly low yields and bond prices have been falling across virtually all jurisdictions and in general, so then giving negative returns over the course of this year. And if we think that there is inflation and rates could go higher, then probably this is not the best place to be. This is global government bonds. an index made up of various issuers and maturities. It's an ETF, but again, lower lows and lower highs. Let's work our way a little bit further forward. Let's talk about what gets helped by rising rates. Well, one of our key themes, as you know, has been financials. And certainly when you get into a market event like we've had over the last few days, everything gets impacted. But certainly financials have been making higher highs and higher lows, and they benefit in general longer term over rising rates and an improving economy. Technically speaking, certainly it's pulled back, and everything has pullbacks, but it's pulled right back into the 150-day moving average, much like it did in September. What I want to do today is show you some of the tools that we use to recognize if there's been a change in trend. So this is a point and figure price chart. Some of you who know us well will know that we use these to help us recognize change points. And it's something that is constructive. We should be seeing higher highs and higher lows, higher highs and higher lows. So this is March, April, some correction through the summer, August, October, November, pulling back to successively higher lows. So as long as we stay in that price pattern, there are more buyers and sellers. We want to continue to be invested. Let's look underneath the hood at some of the groups within the financial sector, because again, a pullback within trend is one thing. A pullback in a breakdown is something completely different. So this is the asset managers and capital markets. You can see a series of higher highs and higher lows. So now, were this to trade down to $100, currently at 108, be roughly 8% pullback from here. That would break trend. That would be something that would cause us some concern. This is the regional banking ETF. Did pull back to the most recent low in October, but right there, holding at that level, there's some support. The insurance ETF, same thing, higher lows all the way along, continues to be very constructive above long-term price trend. The market gives us signals when change takes place, and we have to be there to recognize it. So I spend my day, every day, focused on the existing positions that we have, the changes in our breadth models from a sector to sector, to recognize changing flows and conditions so that we can change our portfolios as are required. As it stands right now, the financial sector, which is by far our biggest weight in portfolios, certainly has pulled back a little over the last week, but continues to look very constructive. Next in our portfolio is technology. Now, technology, in fairness, is dominated by the very biggest companies, and it's a tale of two cities right now. Large cap tech continues to behave extremely well. Why is that? Well, the large companies, Google, Apple, Nvidia, Microsoft, are cash machines. They are generating cash hand over fist. They are involved in large structural themes that have a tailwind and are likely to have a tailwind for a long time. In most cases, these companies have an ability to manage price, and they have great profit margins. They pay rising dividend streams, all of the things that are attractive in a reflationary world. So large cap tech continues to act well. Apple, notable today, of 500 companies in the S&P 500, I think 2 were positive. Apple was 1, certainly continues to have supportive investors. Semiconductors continue to make higher lows and higher highs. And within there, our largest position, third biggest position in the firm is Nvidia, pulled back basically to where it had started the day yesterday, despite the fact markets were much weaker. Cloud-based computing continue to be very constructive, making higher highs and higher lows. You know, we have exposure here in both Microsoft and Google. Microsoft be the biggest position in the firm, holding above the lows from Friday, while the S&P made lower lows. And Google, same picture, sitting at the 50-day moving average, continue to behave really well. I'm not so worried about this group. This is a sector that investors are going to stay focused in. Cybersecurity, same thing, a stair-step pattern of higher highs and higher lows. These are all into the close today, continue to be constructive. So technology, check. Energy, oil's had a really tough week. It's pulled back a lot. Obvious concern is that there could be less travel and less use of oil. Commodities are impacted by the last marginal dollar of demand. It sets the price for everyone. But then we always want to look at what's happening to the company shares, not just the commodity, because the company shares help us to think about what investors are thinking about future profitability in the sector. And the XEG ETF is the Canadian oil and gas sector, simply is pulled back to the 50-day moving average, again, making a series of higher highs and higher lows, continues to be constructive. Now, any of these can change on any given day. And we'll continue to watch them to make sure that they continue to meet our tests and our underlying positions continue to act well. Canadian Natural Resources would be by far our biggest weight, just simply in a consolidation range, trading above all the long-term moving averages. So energy, check. Let's talk about industrials. This is an equally weighted industrials ETF. Industrials are a reflationary theme. They are tied to the economy. In a lot of cases, companies in the industrial space that have a strong franchise have an ability to maintain price. If their costs go up, they can raise prices almost immediately because they're constantly turning over their inventory. Now, they're all different. And certainly this pulled back today. It had a tough day. But again, I go back to that point and figure chart, and we came out of this summer's consolidation to the upside, pull back, rallies, pull back, has failed to break this low, again, continues to act well. Commodities and basic materials, higher highs and higher lows since late 2020. And none of us like to see pullbacks, but certainly, we're getting one right now. Again, all of the commodities behave differently. It's not one sole group. One of our biggest weights in basic materials is agriculture. Hasn't even started a significant pullback. So check here. Let's talk about the consumer. Now, the consumer gets fit into two buckets: consumer discretionary items and consumer staples. In many cases, consumer staples companies that produce food or beverages don't have much ability to raise price, but we are actually seeing it. General Mills apparently raising price on almost all of their goods by almost 20%. Now, we've been very focused in consumer discretionary, specifically in companies that have very, very strong franchise. This is Costco's price chart. We know that they absolutely blew the doors off the most recent earnings and continuing to make new highs. Also within this group, Aritzia, again, a company that has a long runway in front of it as far as opportunity to grow locations and their online presence, and doing very, very well through the holiday season. And then there's Loblaws. Now, Loblaws, you could say, is a consumer staples company, but at the same time, they have strong brand recognition, and they've had an ability to maintain their margins by raising prices. So even though consumer discretionary isn't a big part of our portfolio, they continue to have a check mark beside them. So if I take all of the key sectors that have had strong upward trajectory over the last few months, certainly all of them have pulled back a little bit in the last few days, but continue to be very constructive from a price perspective. This is the MTUM ETF. There's a formula that they use to make their decisions as to what has upward trajectory. It gets rebalanced from time to time, but we talked about this over the last few weeks, and it is made up of all of those groups that we've just talked about. So see if I can jump forward to some of the things that are not doing so well. And it appears, oh, there we go. We're a little bit stuck. Well, we'll start with Telecom. If we think we are going into a significant slowdown in the economy, you would think that investors might like to move their money to more defensive sectors. And we've talked about some of the sectors that are less able to raise price, and telecom is obviously one of them. So this is the IYZ ETF. It holds a series of communications companies, primarily telecom, and certainly had a difficult day today, making a new low. Let's talk about companies that pay a high dividend, but with very little dividend growth. Tends to be made up of bond proxy type sectors. This is an ETF made up of some of the world's most prolific high dividends, not so much dividend growers, and certainly no flight to safety here. Let's see if we can move beyond that this is emerging market dividend payers. Again, we highlighted this over the last few weeks, continued to weaken over the course of this week. When we look at the point and figure price chart on something like this, it's a very different picture than the other things we've been looking at. We made a high in June, pulled back in November, made a lower high in November, pulled back in September, chopped back and forth, and then in November broke all of these lows and broke the long-term uptrend. The market's been telling us for weeks that there's an inflation issue, that we are in a reflationary environment, and that these are sectors we just can't own. Moving beyond income producing assets, technology comes back into focus, but let's look at the companies that are not so profitable, that may be more on the come. This is Cathie Wood's flagship innovation ETF. And while the idea of the sectors is good, the profitability and cash flow is not. If we think that rates are going to go higher, it's hard to pay a high multiple for something with earnings on the come when a rising interest rate might make it difficult from a valuation perspective. These made a new low today. So lots of groups within the market continuing to have a difficult time. This is online retail as a sector. Online retail only grew 10% on Black Friday. It's weaker growth rate than people expected, but we saw this over the last 2 weeks coming in, and certainly this sector has been weak since February. Amazon has had a hard time making progress, and it's the best of the bunch. See if I can jump through to a couple of other groups. This is the online retail ETF. You can see a very different picture, lower lows and lower highs all the way along here. This is software, an unweighted basket of software stocks. Again, often have a subscription price that's a set price, and people sign up a year at a time. And again, making lower lows and lower highs. And we've seen this coming. Each of these weak ones are ETFs that we happen to be short in our global macro portfolio. Again, this has been weakening since the spring. If we look at biotech, continues to weaken. This was the spike back in the original days of identifying a vaccine. And really that once that happened, it was priced in, and the group has had a difficult time. Again, a weak point and figure price chart. So these are sectors that are having a difficult time. And I think that it's really, really important that we make sure that we continue to ask every day, are the themes that we're in continuing to support us in the environment that we're in? And are there big macro factors that could cause us to lose money across all sectors? One of the things we watch is correlation, the degree to which stocks behave the same. And again, you see there's been very little pickup in correlation. So the market continues to sort the good from the bad. So I'm going to say that despite the fact that we had uncertainties unveiled this week, there's not a lot changing. Rising dividend paying stocks pulled back a little over the last week, but behaving much better than high dividend paying stocks. Cash flow generating tech companies doing much better than companies with technology on the come. Companies with an ability to raise price in a short inventory cycle, outperforming companies with little ability to raise price that are very predictable and are not economically sensitive. So again, higher highs and higher lows on the RDVY Dividend Achievers ETF. So last week we talked about the fact that the cash flow coming from S&P 500 companies is close to 3 times the yield in a 10-year bond. We're getting paid well to take risk. As long as we focus on those companies that have strong cash flows, we should be able to do well in a rising rate world. And if in fact Fed Chair Powell is right and inflation does wind up being stickier, I think we're in the right sectors. Financials as a holding continues to grow. Technology, we've taken down slightly some of the more concept-driven positions we've reduced in size. Energy continues to be about a 3 times weight of the S&P. Now, versus the Canadian market, it's not a 3 times weight, but certainly it's a significant weight. Industrials continues to be about an 8% weight, materials about 6.4. The bond proxies continue to be a very low weight in the portfolios. From a Canadian dollar perspective, certainly the Canadian dollar's pulled back over the last couple of weeks. It's trading above a long-term trend line that has been in since early 2020. And unless we see a real breakdown in energy, I'd expect to see that continue to be strong. So we're remaining hedged back to Canadian dollars in our pooled portfolios. And outside of fiat currencies, which are all having a difficult time versus the dollar, the cryptocurrencies continue to be quite attractive. And this week, we had a really nice reversal higher in Ethereum, and certainly Bitcoin improved again. So again, that continues to be a holding in our macro portfolios. Look, nobody likes declines. The average stock decline from a 52-week high, in corrections, a median, is about 13%. And we were about there today. You certainly can have bear markets that are much more significant. And we watch every day for signs that we're leaving a bull market and moving into a bear market. We're not there right now. When we look at big pickups in volatility, if you were to take the largest one-day advances in volatility since 1990, certainly Friday was one of them. It was the fourth largest pickup in volatility since 1990. So that's what, 31 years. It's important, though, to know that when you get a big pickup in volatility, it doesn't mean forward returns go out of your favor. There certainly are cases where 1 month, 3 months, and 6 months out, you could be in a weaker spot. But if you took all of those 20 occasions and looked 3 months out, you had 5 occasions out of 20 where you had a negative return, and the rest were significant positives. So we care about one-day sell-offs. We care about near-term volatility. We have to recheck our themes. We have to recheck our individual positions. If our positions break down, they will go to cash. We are not buyers on weakness. But as it sits right now, I think we continue to be positioned pretty well. So look, there's a lot of folks that are afraid of the fact that it's been a good year. Today was an especially important day because November 30th is the year end for a large percent of the US mutual fund industry, which means two things. By November 30th, they want to have done any tax loss selling they might do for the year. So weak positions got weaker today. Also, portfolio managers are concerned about protecting their returns for the year. The average long short fund in the US this year is up only 4%. So certainly in the last week, some of them have been trying to protect what little gains they've had for the year. But we know when you take the best years and then look at what happens in December, it tends to be a positive month. So we have to take all of the news in the market, put it into the synthesizer, look at what the market is telling us and make our decisions. And we certainly don't get it right all of the time, but we have been over time pretty good at getting defensive when it's required. We've got seasonality behind us. I think the positions that we're in are hanging in pretty well. We know there's big flows to come into the market, January, February, March, and April. So this is where we sit. And with that, Pamela, if there's any questions, certainly happy to answer them.
Thanks so much, Dave. Yes, let me just see here. It looks like we do have one question here. It's about Absolute Software, a stock that's been drifting downward for the last 10 months. Do you have any thoughts on this particular stock? And if not, perhaps then you could speak to a correlated ETF that we are, invested in.
So we talked a minute ago about that PSJ ETF in the course of conversation. Let me see if I can pull it up here. Pam, can you see my screen okay?
Yes, I can see it perfectly, Dave.
So look, there's a lot of software companies that have had a difficult time. The peak in this unweighted software ETF was in February, about 10 months ago. So, it's hard you have to always remember 80% of return is having the market at your back and finding the right sectors and themes to focus in. There are outliers, and certainly, Microsoft is an outlier. Salesforce.com is an outlier. But a lot of software companies have had a difficult time, and Absolute is one of them. I just always believe that if you're in a strong market and your companies are not participating, you got to be willing to step to the sidelines and maybe look at something else. You only need 20 great positions in a portfolio.
Thank you, David. The next question is from Alan in Toronto, a loyal client of Barometer's. He's wondering if you could please comment on the role of gold in the current scenario.
Yeah, so I think it's interesting. Gold has been a very disappointing asset for a lot of people over the last year. Let's just pull it up here. So this is the gold ETF. And, the idea is that gold is an inflationary or reflationary asset. It also protects sometimes in the case of disinflation. I think some people believe that the role that gold plays is being usurped by Bitcoin and by Ether and some other cryptocurrencies. But if I look at this technically, you had a high in August of 2020. So that's what, 14, 15 months ago. And since then, it's been consolidating. What's more is it came out of this consolidation range to the upside and is now having a second consolidation range. So if I were looking at this as a stock, and this was over the last few weeks, I would say that's a really attractive looking price pattern. We know that this was year end today for a lot of mutual funds in the US. There are a lot of funds that would have been looking for things to sell for a tax loss, and this probably is one of them. The equities have been acting a little bit better than the precious metal itself over the last short while. I would probably have some patience here because we are in the environment where gold and silver could perform well, but I think it's been a frustrating hold for a lot of investors.
Well, good thing gold will always have a place in the holiday season, Dave. Especially
I'm reminded of that regularly, actually.
Right, and especially if it comes with diamonds, 1, 2, 3, or 4. We're not picky. Okay, moving on. We have another question here, more on the credit card space, and Visa, MasterCard are often thought of it as technology companies, less than financials, or, here's the question. It says, Visa has been trending lower for the last 5 months and is now back to January 2020 prices. This is contrary to many financials and has been happening for a while. As I mentioned, often these companies are referred to as technology plays, less so financial. So I let you comment on that, Dave. We look forward to your answer.
Look, let me pull the lens back just for a moment. If we take a very long-term picture of the financial sector, sorry, just a second here. This is the banks since 2008, right? It's been a horrible place to be until recently over the last year, and it looks really quite good today. So during that period of time, while people became frustrated in general, the one place within technology to hide was in the card companies. So this is a sector that had very good secular growth. It certainly was hurt more by the pandemic because some of the most profitable business they do is on overseas travel. But the reality is, as there have been other options to focus on within financials, money has been taken from the payments companies and moved into asset managers, moved into insurance companies, moved into capital markets, firms like Morgan Stanley and Goldman Sachs. And so this is a group that has been probably seen as a source of cash. So when a group becomes quite expensive and it becomes quite overowned, it can underperform for a period of time when the money moves around. And it's been really the same story, for MasterCard. It's been it's been the same story for Amex and Visa. Sorry. Second here. There we go. Why is this happening? Nope.
Dave, I mentioned diamonds and gold and I've got you frazzled.
Yeah, sorry. Why is it not showing up? Sorry. There we go. AXP. So this whole group is having a difficult time. And I think the reality is, I know in our case, and this group started to underperform, we started moving to the sidelines. And we're focused in the banks and the asset managers and the insurance companies, which benefit from a reflationary environment.
Dave, really quickly on that, how do you feel about those buy now, pay later companies like Affirm or Affinity or Square, for instance?
Well,
Those
Square
are
is
hybrid.
different. Square is different. You know, but I think that the buy now, pay later story is a really good one. But I would fit it into that camp of companies that are a great idea and innovation that are likely to do well over time, but you're not going to see the earnings and cash flow for a while. So I think you have to be careful. Really, anything that would fit, you know, inside that ARKK, and Affinity would be one of them. I mean, I know it's been a market darling, but there's a lot of market darlings that are running out of steam right now. And I think you want to make sure that everything you own has solid ability to generate cash, and you don't want to pay a lot for blue sky.
Sorry about that. Max agrees with you, Dave. You know what? We don't have any further questions, and you're getting so many comments on such a fantastic presentation, Dave. So with that, I will leave you with the final word.
Yeah, look, nobody likes corrections. And we are always aware that something that starts small can turn into something bigger. So we're just going to keep reevaluating our positions every day. As we need to remove positions, we will. But at the same time, we came into this position for exactly what Fed Chair Powell is talking about. And I think that it always causes some consternation when there's some reshuffling of the deck chairs. And sometimes you just have to sit through as the market sorts things out for itself. And so we'll keep on doing that every day. If there are questions that you have that you'd like to discuss with us directly, don't hesitate to give us a call. If you'd like some help with a portfolio that's outside the firm, we're always happy to talk about that as well. And in the absence of that and other big news, we'll look forward to doing another call next Tuesday. So thanks, Pam, very much for hosting today. And thanks, everyone.
Always a pleasure, Dave. Hopefully next week I'll see you in person.
That would be great. That would be great. We'd like to see everybody in person. And
Absolutely.
Okay, everyone have a great week, and we'll look forward to seeing you again next week.
Thanks, Dave. Bye, guys.